how are rates set on a day-to-day basis? And how is it possible that sometimes a rate could change once, twice, three times in a day?
Yeah. How much time you got?
Man, I'm gonna need to pour a drink for this one, guys.
All right, welcome to another episode of the Context to Contracts podcast. I am Bryan Lovell, here always with Mr. John Jones. And we're going to take folks in a little bit of a different direction today.
Yeah, it sounds good. We're going to talk a little bit about where mortgage money comes from.
Where mortgage money comes from. So to help us out with this, we are going to bring in John Barnes, who is the Chief Secondary Officer. What does that even mean, dude?
I don't know. I'm still trying to figure it out myself.
Chief, the important part is chief.
Is chief, yes.
We'll lead with that.
So John Barnes, welcome to the show. Thanks for joining us today. I know that you're a very, very busy person. John, where do we want to go, man?
We open up. I guess I just want the consumer to know, like, where's this money that we get to lend out? Where does it come from?
Yeah, so like I guess as an example, we'll say this. So we closed as an organization last year.
$2.5 billion.
$2.5 billion. Like we didn't actually have $2.5 billion.
Not sitting in the vault. We did not.
So John might have it in his vault.
No, we're not close to that.
No. So John, tell us a little bit. Like where do lenders get? Where does the money come from that we use to make mortgages?
Yeah. So to rewind the clock back in the day. Before a lot of the secondary market structure got set up, you'd walk down the street to wherever you have, a couple $100 in the bank. You'd walk in and say, I have a job. I've got $800 in the bank with you. I'm looking to buy a house. And they would basically look at what do you have in your bank account and what are you making every month? And they'd say, okay, we're willing to give you this much money. That was before the Great Depression. And even to this day, a lot of people do the same thing. I bank at XYZ Bank. I'm going to walk down the street and walk in and say, hey, I'm looking to get a home loan. The problem with that was when the Great Depression happened, it caused all the banks to basically stop lending completely. So walking out of that, our government actually formed Fannie Mae, which is the Federal National Mortgage Association. And the intent of it was to be able to provide people who wanted to buy a home, whether it was a bank or a lender at the time, an opportunity to where they could lend, and they're not lending money that's out of their personal coffers, their vault, whatever it is. So that was kind of the foundation for the market that we see today. The money that we use to lend, we borrow that 100%. We utilize something called a mortgage warehouse bank, who basically give us a big giant line of credit. And when a borrower is looking to buy a $300,000 house and they're taking a $250,000 mortgage on that one, we say we need the $250,000. They let us borrow it. We then provide that money to a title company, and we're given a time frame then to sell this loan on the secondary market. And that's the part that I think a lot of people don't understand is the secondary market.
So John, can I stop you for just a second? So it sounds to me like that's a pretty big credit card. I mean, is that like essentially
it's like a black card? Yeah,
is like that essentially the same thing? Like the mortgage warehouse bank is like basically a credit card. Like here's a couple $100 million. You guys go make some loans on it.
Yep, they charge us interest for every day that we have an outstanding balance. They charge us a fee every time that we fund a loan utilizing that credit card. And at the end of the day, the expectation is we're going to pay that money back to them.
Okay. So I'm going to dig just a little bit deeper with you. So from the mortgage warehouse line, there's a per transaction fee to transfer funds. And then do lenders pay the balance of the entire warehouse line, or do they pay the balance of what's outstanding on the warehouse line at the time?
What's outstanding. So to use round numbers, let's say we have a $100 million credit limit that this warehouse bank has allowed us to utilize. And at the end of the month, we've got $80 million outstanding. So we've lent out $80 million of that 100 million they've given us. The interest we're charged on that month is on the 80.
Okay. Perfect.
So that's the short-term solution. The long-term solution is I have to pay that warehouse bank back. So I funded that $250,000 mortgage. Somehow I have to come up with the money to actually pay them back so I can fund the next one.
Okay.
And that's where the likes of the secondary market come into play. So I mentioned earlier Fannie Mae. They are a secondary market solution where I'm able to sell or pool a group of loans and deliver that to Fannie Mae. Fannie Mae then owns that loan. I, as VanDyk Mortgage, retain the right to collect the monthly payment. So odds are anybody who has a mortgage, it's probably owned by one of three government entities: Fannie Mae, Freddie Mac, or Ginnie Mae. And whomever they're making the payment to is basically servicing the loan on behalf. They're collecting the payment and making sure that all the information gets relayed through to those entities.
Okay. So that makes me ask the next question. And all right, so lender makes a loan off of their warehouse line. They're interested in getting that money back into the warehouse line so that they don't pay the interest on it. And they get the money to do that from one of these government-sponsored entities, GSEs, right? So where do the GSEs get all this money? We're talking trillions of dollars.
Yeah, on an annual basis. And when you extrapolate it out, I mean, they've made whatever the number above trillions is.
What's the zero after a trillion? Is it a gazillion?
It's, I think,
Is it a gazillion?
a gazillion sounds about right.
So what they do is they form pools. And what pools are they are groups of loans. And there can be very small pools. They can be $500,000 worth of loans in a pool. It can be $500 million worth of loans in a pool. They package those up and they go to Wall Street with them. What happens there is you've got investors who want to invest in real estate. It's a good investment for retirement funds, for short-term investment, long-term investment, whatever it might be. They have an opportunity to buy into this. So I've got $100 million I want as a hedge fund advisor. I'm going to buy into one of these big giant pools that are out there, and you're guaranteed to get a rate of return. So let's say, for instance, we form a pool and it's primarily note rates that are in the 4% range. So 4% up to maybe 4.5%. We, as a servicer, are entitled to a portion of the interest rate, of the interest that's collected on a monthly basis. The rest of that gets remitted through. So they get that return on top of it. Okay. So for $100 million, we'll offer you 3.5% interest rate.
Okay. So is it fake money then? I mean,
No, it's absolutely real money. I mean, obviously, it's all just zeros, but
yeah,
it's real dollars that are exchanging.
Large hedge funds are buying this and putting it in their portfolio for people that are maybe my age and older that want to be a little bit more conservative,
safe
going
with their
into
money.
Retirement.
So there is a dollar for dollar exchange of, hey, here's $100 million pool of mortgages, and they're going to pay $100 million for it.
Yep.
Okay.
There's
all right.
Obviously, and minutia to it, but yeah.
And then the fixed rate of return is how those investors get a rate of return on the investment that they made. All right. So they, let's say that hedge fund, like you said, buys the $100 million mortgage pool. That money actually then goes to Fannie Mae.
Correct.
Okay. So wow, that's like a lot of changing hands. Mortgage warehouse bank, lender, Fannie Mae, hedge fund. Wow, there's a lot of changing hands.
The goal of it is to have Fannie Mae and Freddie Mac and Ginnie Mae. Those are the three GSEs, government-sponsored enterprises. They're that centerpiece. So all the lenders come to them. So everyone's going into them. And the same thing with Wall Street. All the investors are coming into them then. So they are kind of that central spoke to allow liquidity to the mortgage market. So they're going to take your loans, they're going to buy them from you. Mm-hmm. And the leverage on the other side is all these investors. I don't have to go directly to Wall Street as VanDyk Mortgage and try to find someone to buy my $100 million worth of loans.
Yeah, because you're gonna give them over to one of the GSEs, and they're gonna pull them to
Yep.
go forward, right? So they're kind of the middleman.
Correct. Yep.
Yeah.
The key to that is when we sell a loan to Fannie Mae, Freddie Mac, or Ginnie Mae, we retain the servicing rights to those. So that's the right to collect the payment on a monthly basis. And we get it's a very small cut of the interest that's collected on a monthly and annual basis. But that's where the biggest money is on the mortgage lending side.
Is in the
servicing
servicing
side.
Correct.
Okay.
So the goal on the origination side. So when we go through the primary market, which is origination, processing, underwriting, and closing. Your goal with that is when I go and sell that loan to Fannie Mae, Freddie Mac, whomever it is, or maybe I decide I want to sell this off to an aggregator that's out there. My goal is just to break even on our hard costs here.
Okay.
So I don't want to make money when I'm selling the loan. If you want to make money, it's all on the servicing side. So let's say it costs, in terms of all the things to originate a loan, it cost me $5,000. My goal when I sell that loan is only to make $5,000. If I go above that, great. I did a good job.
So what happens if a lender decides not to retain servicing? Are they selling that loan at a premium to somebody else then who wants to collect the servicing, I'm assuming, for a fee?
And that's where you're going to see the aggregator market come in. And that's going to be, the big names that are out there, Wells Fargo, PennyMac, AmeriHome. They go out there and they're acquiring these loans from the likes of mortgage lenders who close them solely with the goal of they want to acquire that servicing because, again, that's where the money's made. So their goal is they just want to break even on their side. So if it costs, they have to pay me my $5,000, and if it costs them $500 to acquire that loan, their goal when they sell it is to make $5,500 on the loan.
Okay.
They break even at that point. Most of the time, they're losing money on that side, but they're doing it with the promise that this borrower is going to make their payments, and I'm going to get a cut of that servicing interest every month. So it's a long-term investment for them.
Right. So you're circling back. I mean, I think it's important that whoever's listening understands that because we're selling directly to Fannie, Freddie, and Ginnie, that we all, as lenders, originators, are underwriting to a certain standard level. So let's say if we're going to lend or qualify a borrower the same way as Bank of America, is the same way as Wells Fargo, as far as making these loans sellable.
Yeah, because they all need to be saleable to one of those GSEs. Yeah, so I think that's a lot of times there's a miss there, because we hear,
my local bank won't ask for
that. And the reality is I always call it like they've got to fit into a box, right? There's a guideline for each one of those loan programs. The guidelines are the same for everybody. It's an even playing field, right? And the box is set by those 3 GSEs.
Right.
Yep. So, and the box is basically set for their appetite of risk, right? So, like,
correct.
John, in the unfortunate scenario where there's a default, how does that play into all of this stuff?
That's a whole other wrinkle to this. So, on what I'll call on the Ginnie Mae side, those loans are going to be insured by FHA, VA, or USDA. On the conventional side, so those are going to be loans that Fannie Mae and Freddie Mac are buying. Though anything that has an LTV above 80% has private mortgage insurance. So you basically have insurance on these loans in the event they default. On the conventional side, it's only if you're above 80% LTV. So there's only so much protection that you get, and it only protects you so much from loss. Mm-hmm. That's actually what got Fannie Mae and Freddie Mac in a lot of trouble in the late 2000s. Yeah, they were in a situation where the mortgage insurance companies weren't paying because the servicers weren't doing a good job, and the loans that they had were originated out of compliance. They didn't fit in that box you mentioned. So Fannie and Freddie had to put them on their balance sheet. They had to buy these loans out of the pool because they weren't Wall Street quality. Mm-hmm. And that's what got them in trouble, is they were bleeding money left and right, and they had no way to solve those. So it can be an issue on everybody's side. On the servicing side, we're in a situation where we have to advance the interest on some of these loans. So we have a cash investment on our side. If loans go into default and ultimately foreclosure, we're carrying those costs until one of those insurance companies, FHA, VA, USDA, or
Kicks
PMI,
in.
pay up their portion of it too.
So the penalties, if we miss the box originating a loan right now, in today's market with the changes of Frank Dodd and everything, what's the onus or the responsibility of us if something gets missed?
If it doesn't fit into that box, it's not saleable to them.
Okay.
So if it doesn't fit into the box for Fannie, Freddie, Ginnie, you're pretty much cooked. Now there is an appetite out there for these near miss loans of, I miscalculating the DTI by just a hair, and it's not going to be saleable to one of these outlets. There's someone out there, typically REITs or hedge funds, who have an appetite on this and will take the servicing, and they basically portfolio the loan. That means they're taking money out of the investments they have or out of their vault somewhere, and they're paying us the money, but they're going to buy it at a discount. So if it's a $200,000 mortgage, they're probably only going to pay me $180,000
Okay.
for that loan if it's a miss.
Okay. But that would allow, even if it's a miss, that's going to, so to kind of backtrack a little bit, we talked about it starts with this mortgage warehouse line. We lend the money as a lender. We get our money back to pay off the mortgage warehouse line through one of the GSEs. If it's a miss at one of those GSEs, we don't get our money back for that. So now we're kind of like
Scrambling.
We're
to find
missing
a
a
home.
payment on that credit card, like we talked about.
Right.
We'll call it a credit card. All right. So at that point, instead of being able to pay off that credit card in full, you're only going to be able to pay a portion of that credit card off in full. So to some degree, you got to have the capital of your own money at that point to make that up. Am I hitting it?
Spot on. It's all a risk game. You're taking the risk that, you expect mistakes to happen, unfortunate as they are.
Mm-hmm.
But you're taking the risk that the vast, vast majority of the loans that you're closing are going to be ones that you're going to be able to get rid of. And when you mess up, you got to have some money in your back pocket to pay the bill.
Yeah. Okay. Yeah. So like if there was a mad, crazy run on a bunch of defaults, that would put a lot of lenders in a difficult situation because they would be undercapitalized on their warehouse line to be able to make loans, right? And so I think there's a, I don't want to, what's the word I'm looking for? There's a phenomena, I don't know if you want to call it a phenomena. There's something coming up here soon that we could see, some of that happening, right? Because right now, because of the CARES Act, there's a number of homeowners who are currently in forbearance, right? Meaning those payments aren't being made. As the lender who made those loans, we have a responsibility to remit some payment for those. But if at the end of the day, they're not able to get out of forbearance and they go into default, then we're going to have to pay those credit cards short, basically, right? So, we've talked about it, John, here on the podcast before. Our feeling, and we'll get John's opinion here in a second, I'm sure, is we don't see a huge amount of defaults coming because of the homeowners having so much equity in their home today that if they get into that situation, they should just be able to sell the home, pay off the mortgage, and move on. What are your thoughts on that, John?
I agree. We're in a rare situation right now where
The market is
the
smoking
values on
hot, yeah.
homes have increased so aggressively. And they've been very, very stable, honestly, for the past decade. So there's a situation where you could have bought a house 2 years ago, you lost your job, unfortunate things happen. And in the early 2000s, you would have been underwater by 20-30% of what you bought it for. Now you're in a situation where you might be up 15 to 20%.
Mm-hmm.
The bigger concern I have is for those borrowers where maybe their income has changed. They went from making $4,000 a month and now they're only making $2,000 a month. They can't afford to stay in the house.
Mm-hmm.
What do we have on the rental side to help these borrowers? Because a 2-bedroom apartment isn't going to work for somebody who's got 3 kids.
Yeah.
So they're looking at renting a house. Are you able to get a house on the income that they, and that's the scary prospect I see is what do we have as an alternative housing source for some of these borrowers when home ownership isn't in the cards today?
Yeah, and the rental market's smoking hot as well. And here in Florida, I know, like, just to rent probably a 3.2 is well over $2,000.
Wow.
Where homeowners are probably paying that on their mortgage currently. So they're not really going to get a benefit by leaving the existing home. So the concern would follow is how long would they maybe try to continue to stay in the
Okay.
home, post expiration of the CARES Act. That could take.
So I'm following what you're saying. What you're suggesting is that, hey, if I sell my home, I can't afford to go rent another one. So how long can I live here without paying
Before
my
I-
mortgage
Potentially.
and hopefully get caught back up? And that's what would lead to a default and eventually a foreclosure.
Yes.
Yeah.
Okay.
Yep.
I'm following you.
The crazy thing is, with the lessons that we learned coming out of the 2000s, there are so many options to keep a homeowner in their home right now that, as long as they try and they actually have the income and honestly they communicate, it's going to be difficult for a borrower to be facing that situation where they just flat out, there's not an alternative for them. Either the income loss that they had is too great, and honestly, yeah, you need to downsize, or you need to be looking at something different. But there's so many alternatives out there on the servicing side right now to foreclosure.
Mm-hmm. Yeah. So I have a question too. Going back to that mortgage line of credit, or that credit card, so to speak, is it one of those things like use it or lose it? Or, like, I guess what I mean is, like, let's say a lender has a line of credit of $100 million, but they're only using $60 million. Is that going to affect the way that they do business?
Yes, it will, 100%. So and typically it's banks that provide these, but there are private entities that do as well.
Mm-hmm.
So when a warehouse bank actually allows you $100 million, their expectation is that you're going to have a certain utilization of that.
Okay.
They're basically earmarking on their side, okay, I have $1 billion that I can lend out on a regular basis, and I've got 100 lenders. Here's the breakdown of what it needs to be. If you don't utilize a portion of it, you're impacting their ability to go out and lend that money to a different lender. So there are non-use fees. There is underuse fees that you face, and everyone's going to be different. Some of it might be 50%. Some of it might be, you got to be 40% utilization.
Sure.
But you do get charged a fee if you don't use a certain percentage of it.
Okay. Yeah. The reason I find that interesting is, like, I have a credit card, like, just say through my bank, that I mean, I haven't taken it out of my wallet in a year and a half probably. And I swear, like, they send me emails constantly
Increasing your line.
with that and incentives to, like, hey, if you'll charge $1,000, we'll give you, an extra $100,000 rewards points, or something crazy. Like, they're always trying to get me to spend. Of course, what they're trying to do is to get me to overspend, right?
Or miss a payment.
Or miss a
Collective fee.
payment, right? But I mean, it's kind of similar in that regard, right? We're talking small lines of credit. Let's say you have a $10,000 credit line versus hundreds of $1 million credit lines, but I'm sure that it's the same. It's just scalable, different.
Yeah, I'm curious. You mentioned that you have to use the line, but how was the scramble a year ago when rates dropped? I mean, with the existing credit lines, and what did the lenders face then when rates really dropped and the market took off? And how difficult was it to get those lines increased?
I will say, from our situation, it was not difficult. We have incredible relationships with the 4 banks that we utilize. And from our side, it was as easy as picking up the phone and saying, hey, we need an increase, and here's the percentage we're looking at.
Wasn't the case everywhere, though.
Oh, no. There were a lot of lenders that were scared. And the crazy thing a year ago is the guidelines shifted so quickly.
Mm-hmm.
You went from, the minimum credit score for most outlets was probably somewhere around 620 for govies, and they had DTI restrictions. And then COVID happened, and all of them shot them up. They kicked up to 680, some of them 700 for a minimum credit score. no manufactured, no high DTIs, no high LTVs. They basically said, we don't want any of this risk. And a lot of lenders were stuck with loans that they couldn't sell. They had to look to that tertiary scratch and dent market, where your people are buying stuff on a discount, because that was the only way they could get rid of them to keep funding loans that were good and that they could sell. We were fortunate that we do have Fannie, Freddie, and Ginnie tickets. They never faltered. They never changed. They put out some additional guidance or guidelines that we had to do, but we had a for sure outlet at the end of the day, and we have an appetite for servicing. So for us, that transition was easy, and it was small increases. It wasn't like we were walking in saying, hey, I need a 200% increase to handle this volume. It was, hey, I need another couple million here. Can you help me out?
Okay. Yeah. Is the fees that a warehouse bank, what they would charge in terms of per transaction and your interest rate on your balance, are they different among other lending institutions?
Yes. Yep. 100% there.
So like, what would that be based on?
A lot of it is just negotiating. You walk into a contract with a set fee, and that's just what their standard is for their contract. Once you get a familiarity with each other, they understand, hey, we're not messing around. We're going to get stuff purchased off in the timelines that you need and replenish, pay that credit card. They typically will work with you, and they'll move the interest rate that we're charged down. They'll move the per file fees down. But at the end of the day, it's business. They're looking to make money.
I mean, they are a for-profit business, right? Yeah.
Yep.
So
and they got to support their overhead. But it's entirely negotiated. I know specifically a couple of lenders that we utilize the same warehouse entities with, and it's completely all over the board. We're typically better than them because we've got a better quality and a better relationship with a lot of them. But there can be huge discrepancies in that.
Yep.
Hundreds of dollars.
And that's going to affect the rate that you take to market, right?
Yep.
Yeah, and talking rate to market, I mean, I think it's important for the consumer to understand, if they're listening in, is how a rate's set on a day-to-day basis. And you know, how is it possible that sometimes a rate could change once, twice, 3 times in a day?
Yeah. How much time you got?
Man, I'm going to need to pour a drink for this one, guys. I can sum it up in a real easy answer. We all are selling the same exact rates. It doesn't matter whether you're at VanDyk Mortgage or ABC Lender down the street. We all use the same baseline for it. It's your cost, it's your efficiency, it's how much is it, what is my break even? So when I go to sell this loan, if I got to make $5,000, the interest rate that we provide to the consumer is going to dictate what rate it is for that $5,000 I need to make. Lender down the street might be at $6,500, so their interest rate's going to be higher. Or lender, but you go to internet lender down the street who it's going to take you 75 days to get a loan through. Yeah, they're lower cost. It might only cost them $2,000 to get the loan through, but again, it's taking them 75 days. So that's the biggest thing. And because we're all dealing with the same rate set, when the price that we get from Fannie, Freddie, and Ginnie change, that's what dictates the change on our side. I have to make sure that I'm making that dollar
Same
amount that I
margin,
need
yeah.
to break even.
Any other questions that you have?
I think I'm good.
Yeah. John, is there anything like we should have talked about in regards to where mortgage money comes from?
No, I can say when I graduated college and ultimately stepped into a secondary marketing job, I had no idea what it was. But I think it carries this almost like Wizard of Oz feel to it, where people kind of perceive you as the guy behind the curtain pulling the strings and making millions of dollars left and right. It's not the case. All we're honestly doing is what we described. I'm looking to make sure I can fund the next loan and that we hopefully break even in the process.
Yeah, cool. So, I think there's an opportunity, in the future for us to bring John back, because I think the next side of this question is, what are some of the things that, dictate
Mortgage rates.
what mortgage rates are? We didn't even really get into that today, and there's probably a lot of folks who are interested into that, but it's interesting to take a look, to John's point, behind the curtain, like, where does all of this come from? to be able to put, folks in home in as rapid a pace as we do. John, just out of curiosity, my last question. How long does it take from the time that we lend somebody money on their home for us to pay off what we borrowed against that warehouse line?
If I'm delivering that to Fannie Mae and Freddie Mac, typically under a week.
It's crazy.
If I'm actually going to market, so with Ginnie Mae, we're forming those pools that go to Wall Street for Ginnie Mae.
Okay.
Those take a little bit longer. That's probably 4 to 5 weeks.
Okay. Wow, that's pretty fast.
Yeah.
I mean, you're essentially paying your balance off every week.
A lot quicker than the consumer.
Yeah, a lot quicker than the consumer.
In most cases.
Yeah. Which is why the interest rate's not 14% or 22% or whatever, right? You're late like one day. Boom. 22% interest.
I better pay this.
Have a nice life.
Right. That's the vig.
Yeah. Well, John, thanks for joining us, man. We look forward to having you on again sometime. So for tuning in, thanks for
Thanks, John.
What's that?
I said, thanks, John.
Yeah, thanks, John and John.
Thank you, Bryan.
But thanks for tuning in to another episode of the Context of Contracts podcast. On behalf of John Barnes and John Jones, I'm Bryan Lovell. If there's anything that you need, we're always here to serve.